Sales less variable cost. I do agree with you. Sales less VC equals to CM. CM means contribution margin, not the chief minister of your country, right? Any country. Okay, no, in India, Pakistan, there are chief minister systems. In Bangladesh, there's prime minister system, and UK also prime minister. Although in in those countries they have prime minister. CM, contribution margin, yeah, not the chief minister. Or contribution, you can say, sales less variable cost. Okay, now Mr. Mobile, don't disturb me, yeah? I'm putting my mobile phone a little away. So that's you do as well, yeah? Put your mobile phone a bit away. So that would be great for today's lecture. You know, people, let me, before I start, let me give you two options here. Product A and product B. Let's talk about two products, yeah? Sales less variable cost, you get CM. Contribution margin for product A, £6,000. Do we have to make a decision about two machines to invest? Yeah, why don't you? Don't you do this in real life? You do. Here as well, you do. Okay, contribution margin £6,000 for A, and for B, it's £5,000. Okay, the contribution less FC. After contribution, you deduct fixed cost, don't you? Now let's assume that's your business. Under one roof, you're going to produce two products: product A, product B. Product A giving you £6,000 contribution, product B giving you £5,000 contribution. Now, fixed cost, individual product. It could be product, it could be department. Either way, you can think. Yeah. Let's this time think about department wise. Department A, DEPT. I'm just giving you a general knowledge question. Yeah, no accounting. Department A and DEPT, Department B. Contribution 6,000, 5,000. Now in Department A, your fixed cost is 5,000. Also in Department B, the profit is going to be 1,000. And Department B fixed cost is also 5,000. Profit is 0. Now, generally, if anybody asks you which product you don't want to produce, simple answer, you might say B. Yeah, simple answer. No accounting knowledge, no finance knowledge. B. Okay. You don't want to. One is you don't want to, and you want another question I'm going to ask: which product you are not going to produce? You're going to close. Again, if you say B, and yeah, because it's zero profit. Who wants to produce a product who gives you a zero profit? Now you are not producing that B. What is going to happen? You're going to lose that contribution because you're not producing B, you're not selling B. How can you get contribution? Can you get contribution? Answer is no. So, okay, you're losing contribution. Second question is very important, or the concept. You know, the fixed cost, whether you produce or not, that it might be a product, it might be a department, anything you can consider at this moment. Whether you produce or not, that fixed cost gonna occur anyway, because fixed costs are unavoidable unless you fully abandon that business, don't you? Yeah, like let's assume you have taken one big storeroom where you can keep A and where you can keep B simultaneously, part by part, and the entire cost is £10,000. So 5,000 for A, 5,000 for B. Yeah. So these 5,000 fixed costs gonna occur anyway. Are you understanding me? You stopped producing B, but it's gonna occur still because you're going to pay 10,000 fixed cost. You split it between two department and product, but you didn't close your business. As long as you keep continue your business, you have to occur that particular fixed cost. So do you think it is wise to not produce the goods? Of course not. It is good. It is not wise to stop making B. At least the contribution is covering your fixed cost, isn't it? The contribution is covering your fixed cost. Yeah. So here in this point, you need to make one point that fixed costs are irrelevant cost or unavoidable cost, isn't it? Variable cost can be avoidable. You don't produce a good, you don't need to make the payment for labor or material. Right? You don't need to buy material, so you can avoid it. We call it avoidable cost or relevant costing. So here, contribution is very important. We call it MC approach, marginal costing approach, or contribution. I'm summarizing the whole story. Maybe some students, they still struggle with this concept. The entire point of this contribution approach is, as long as a product or department giving you contribution, you're gonna continue producing that product or service on department. Simple, okay? As long as a product or department giving you contribution, you will say green signal to that product. Yep, that is your contribution. Moving to the SCVP, cost volume profit analysis, there are a few, minimum five formulas you need to remember. Formulas. Write it down now. As we progress, keep writing and let's going. Yeah. Let's start with first one, break-even point. Yeah. Did they give you a formula? They gave you formula here. Fixed cost divided by contribution per unit. Write it down, then we will explain. Yeah. I hope everybody knows the explanation, but I will explain. Formula number one, I'm putting one. Actually, two. Formula number one was this one. It's S less S, sales minus variable cost. Yeah. Sales less VC is your contribution. That is number one, contribution. Number two is break-even point. Number two, break-even point, fixed cost divided contribution per. Now, what is a break-even point? It's such a point where there is no loss or no profit, they say it, or sales revenue equal to the total cost of the business. Break-even point is such a point where we cover all cost. Yeah, giving you a quick example, like all cost means variable VC plus FC equals to AC or TC. This total cost, variable cost plus fixed cost equal total cost. Total cost means all cost. Yeah. Let's assume, yeah, I'm writing with a pen. I bought 1,000 pen, and 1,000 pen costed me fixed and variable altogether. If each pen, this is a digital pen, expensive £5, so £5,000. £5,000 is the cost of this pen, right? Now, I kept selling the pen, selling from 1,000. I sold, let's assume 700 pen. And by selling, I put cash sales. My sales, total sales are £5,000. Isn't it my costs are covered at the 700th pen? Yeah. When I sold until 700 pen, all my cost cover. After that, whatever I sell, whatever means 300 more I sell, that is known as what? Give me anybody answer. MOS. After that, everything you sell is a profit, isn't it? That is a simple word. Yeah, non-accounting word. But because you're professional students, you better use the professional words. After break-even point, 700 is your BEP, I said. It's just an imaginary figure where we covered all my fixed and variable cost. And after that, whatever you're selling is profit. We call it margin of safety. MOS means margin of safety. So you can see the formula of margin of safety as well. Like formula of margin of safety is total sales, means budgeted sales, or you can say total sales. Say, or just sales less BEP. BEP sales. We call it budgeted sales minus BEP. Budgeted sales was 1,000 units, and break-even sales is 300 equals to, 700. Break-even is 700, and 300 is your margin of safety. I hope you got my another formula. Yeah, you can put it third formula. I have no problem with that, but I can see there are more. CS ratio is another formula. Yeah, margin of safety is here, but that is the margin of safety. Budgeted sales minus break-even sales. Budgeted sales was 1,000 units minus break-even sales was 700 units, and you get 300. Getting a question, is it how much sales can reduce before a business incurs? Is it how much sales can, I didn't get your question, to be honest, quite. What was that? Is it how Shazad is asking, is it how much sales can reduce before a business incurs a loss? Still, I'm not sure. But just these are simple things, which is margin of safety is your profit. After break even, anything you sell is your margin of safety. You're happy, you're dancing, you can think of buying new car or house or make your money. Yeah. So people, let's keep talking about one by one. Yep. Break even point in front of me. Here you can see an example: sales less variable cost, you get contribution, less fixed cost, you get profit for the year. Although the profit here, break-even point, another formula, another way of saying it, where profit, no loss. No profit, no loss. Break-even point is such a point. Profit is 0. Or no profit, no loss. That means all your variable and fixed costs being covered from your sales. 5,000 is variable cost, 10,000 is fixed cost, total sales is 15,000 equals. Yep. No profit, no loss. After break-even point, anything you sell is your profit. Hope you're okay with the break-even point. Break-even point you can get in terms of units, fixed cost divided contribution per unit, or you can get in terms of revenue. Revenue means pound. Yeah. Let's put some imaginary figure. Fixed cost is 50,000 pound, and my contribution per unit is 2. So it's going to be 25,000 units. 25,000. Still, I trust my calculator. Divided by 2. Yeah, 25,000 units. So business, whatever you are selling, whether pen, calculator, anything, if you sell 25,000 units, you can cover your costs, fixed variable, all costs you can cover. So 25,000. But in terms of what do you call it, revenue, how do you get it? There's another formula, but tricky way of doing it, times by selling price, SP. I didn't give you selling price. Let's assume selling price is 5. Yeah, selling price is 5. SP was 5, VC was 3. So that is the reason of contribution 2. So yeah, thank you, Shazad. So in terms of revenue, if you want to get it, 25,000 times by 5, it's 115,000, 125,000 worth of pound you need to sell. In terms of monetary value, you need to sell and pocket a cashier bank 125,000 money. Then you can get into the break even. This is in terms of money. This is in terms of units. Both of these formulas you need to remember. But you multiply with selling price, you get your answer. 5, I said. All imaginary I'm using. I'm going to give you a question in a few minutes time. So stay tuned. But you can use CS ratio. Now you can say, Elias, what is this? Okay, this is another ratio that helps you to get the answers in revenue, money. Pound, revenue, in terms of revenue, money, monetary value. Okay. So, but what is the formula of CS ratio? Contribution divided by sales. Like contribution 2 pound, we said divided by sales is 5 pound. You see the earlier example I drawn it. So let's see how much is my CS ratio. 2 divided by 5. My ratio is 0.4 equal to 0.4. Let's try to prove it. Yeah. Like the above here, break-even point was 25,000 units, wasn't it? And if we divide it by CS ratio is 0.4, shall we get 125,000? Do you get it? Divided by 0.4. Hold on. Fixed cost divided by CS ratio. How much is the fixed cost? We said 50,000. Sorry, I took a wrong figure. 50,000 is my fixed cost. Yeah, 50,000. 50,000 is my fixed cost. 50,000 fixed cost divided by 0.4. Yeah, can you see 125,000 fixed cost? This is not 25, 50,000 divided by 0.4. You get the same figure. People, I'm going a little faster, I know, but are you getting these things? Yeah. Yep. I already showed you. I'm summarizing very quickly. First formula for contribution, easiest in the world, sales less variable cost. Second formula, second and third formula is break even basically. Second is break even in terms of units, fixed cost divided contribution per unit. And third one is revenue, which is using the CS ratio, like fixed cost, FC. In terms of revenue, do FC divided by CS ratio. CS ratio. If I put another, how do you get CS ratio? That is your fourth formula. So these are the formulas we have done so far. Margin of safety I showed you as well. Fifth one, MOS, we call a margin of safety, which is Fifth one, margin of safety, sales, budget sales, less break even sales. Divided in terms of percentage, if you want to know, budgeted sales, you know, in our example, we gave at the beginning example, 1,000 units we want to sell, and my break-even sales, we said 700. So margin of safety is 300. Let's do it on a screen calculator. Budgeted sales 1,000 minus break-even sales 700 divided by budgeted sales 1,000 again times by 100. That means 30% is the margin of safety. Hope you're okay with that, yeah? 1,000 minus 700 divided by 1,000 times by 100 equals to, it gives you a percentage, 30% here, MOS, which is really good, not bad. Margin of safety is 30%. The higher, the better though. That's how you do it. Okay, happy with that? And I believe this is the last formula, sixth, formula number 6 is target required profit. I also call it target profit. Simple formula is this: FC, fixed cost plus target profit, or required profit divided by contribution per unit. Fixed cost plus target profit. Now, whatever is your fixed cost, if you can say 50,000, and one of my example, I used it, plus target profit, I don't know, anything you can say, like we want to achieve a profit of 10,000, divided by contribution per unit, 2, 3, 4, 5, whatever it is, you're going to get answer in terms of units, If you use contribution per unit at the bottom, you get in terms of units, like you need to sell 50,000 units, 100,000 units, 200,000 units to achieve your profit of 10,000. What is the target profit again? Required profit. The manager told you, oh, Mr. Employee or Mr. Junior Manager, I want 10,000 profit at the end of this month or at the end of the year. I don't know how much units you want to sell it, but I want 10,000 profit. So what is the formula you're going to use? This is the formula: fixed cost plus target required profit divided by contribution per unit. So you're going to sell that many units. If you want to know in terms of monetary value, you do again fixed cost FC plus required RP. Yeah, that divided by CS ratio. Target contribution means fixed cost plus target required profit divided by CS ratio. Quickly going over this illustration number 1, then I'll give you an activity to do. How many of you are here? Anybody into the queue? No, not actually. Okay. Reardon Enterprises manufactures a product called Paper Pot with the selling price 10 per unit. The variable cost of producing the product, variable cost, be careful with that. And sales given. Quickly tell me the contribution. Everybody, yeah? Don't be lazy. Fixed cost given. Yeah, of course. Thank you, everybody. Yeah. Yeah. Well done. You people are not sleepy people. You people are generally active working people. I know you. Level 4 people are good and working, but today is slightly quiet. Okay, fixed cost given. So fixed cost FC divided by CM. You get your break-even units. Like if you can sell 50,000 units of the goods, you can cover all your cost. That is break-even in terms of units. How about in terms of money? You just multiply with the selling price times by 10, don't you? 50,000, highlighting, times by 10, you get 500,000. So if you can sell 500,000 pounds, your costs are covered. After that, everything is your margin of safety. So that in B, you can do 2 ways. You multiply with selling price, or you can use CS ratio. They're using CS ratio as well here, which is 0.4, and fixed cost divided by CS ratio, FC divided by CS ratio. You get the same figure. Third one is MOS, I believe. Yeah, margin of safety in terms of units. What is the formula? You know it, yeah? Fixed sales minus break-even sales. So how much is the sales, your budgeted sales here? 70,000. Where do you get it from? In the question. Where about in the question? This is my budgeted sales, which I just circled, 70,000. How much is your break-even sales? 50,000. So obviously 20,000 is your MOS, margin of safety. But in terms of a percentage, if you want to get it, they said 28.6. How do you get it? MOS sales divided by budgeted sales, which is 70,000. Times by 100. You can do on your calculator, you get 28.6%. Good percentage, nothing wrong. Anything above 25, I would say very good. But when you compare with other business, then you need to explain which one company is good and how they can be better and all. If Okay, let's play around, everybody, before I move on, because I have seen in the exam this type of question comes in. Let's play around. 20,000. Let's play around with this one. With this one. With this one. Now your fixed cost is 200,000 and contribution is 4. You get 50,000. Now I'm reducing your fixed cost. I'm making your fixed cost 150,000 and contribution is 4. How much is your break-even point? Have a look. You can work it out and give me the figure. 150 divided by 4. Can you see the break-even point has dropped down? Thank you, Shazad. 37,500. Yeah, I got the same. What does it mean? What does it indicate? Is it good thing for business or bad thing for business? Tell me something. That I hope somewhere given in the chapter. Is it good or bad? Quickly tell me. Ooh. Oh, why people saying, why you think it's bad? Okay, now I'm getting some good answers. Okay, the lower the break even, the better, isn't it? My question was, which one is better? 37,500 is better or 50,000 is better in terms of break even? The quicker the break even you reach, the better, isn't it? Yeah. Good, because it's easier to sell more units after a break even point. Yeah, Joseph, thank you. Yeah. Okay, Shazad, why you can check the Joseph's answer, but or you can say, or just think about this wise. Let's assume this is Mr. A and this is Mr. B. Yeah. Mr. B's fixed cost is 200,000 and Mr. A's fixed cost is 150,000. Obviously, Mr. B is better. Mr. B's fixed costs are less. That's why they're better, isn't it? And they can get into the break even as soon as better, isn't it? I want to cover all my costs as soon as I can. After that, whatever I sell, so my MOS would be higher, wouldn't it? Be careful in that. So your fixed cost plays a role. Or even even I could have played around with this one. Yeah, I could have made it 2 or could have made it 6, like contribution. Yeah, higher the contribution, the better. Lower the expenses, the better. We know these simple things, but when in terms of calculating and putting it into this effect, it might get a little complicated, just the way you, some of you went confused. But I hope it is crystal clear to everybody. Yeah, why the lower break even, the better, because you are quickly covering all your costs and maximizing your profit. That comes as a theory, maybe some slightly calculative as well. Let's play around with this one now. Yeah, margin of safety. Okay, again, Mr. A and Mr. B, talking about. Mr. A has got margin of safety 20,000. Mr. B got margin of safety 10,000, and their sales are same, 70,000 and 70,000. Who is better here? Tell me now. It's about margin of safety. Is A better, B better? Think about it. Think about it. What do you think? The higher the margin of safety? Ooh, come on. I'm getting mixed answers. Yeah. What is happening? Everybody participate. Yeah. The higher the better. Yeah. The higher the margin of safety, MOS, the better. Yeah. Yeah. So here, this 70,000 is your budgeted sales. Yeah. And this 10,000 and 20,000, I said MOS, margin of safety. For B, how much is your break-even sales? Yeah, break-even units or sales in terms of units. Tell me. For B, now everybody needs to answer. Come on, get into the answer. For B, Mr. B, how much is break-even units? Budgeted sales 70,000. Yeah, simple. 60,000. Yeah, 60,000 is the break-even. After that, until 10 more thousand is your. So can you see I'm asking you so many like out of the box questions? Yeah, because level 4, you need to think that way, out of the box way, not just structured way always. Okay, so moving to the last formula here, which is required profit, E, number 5. Let me see. Yeah, sales units required. So Mr. Manager told you, I want 100,000 profit. I don't know how many units you want to sell it, but to give me 100,000 profit. So what is the formula? FC plus R required profit divided by contribution CM. So FC is given 200,000, required profit is given 100,000, contribution is 4. So you need to sell 75,000 units, right? How do you get the monetary value of these 75,000 units? What is the monetary value of these 75,000 units? If you scroll up and take some information, good. Thank you, Omid. Selling price times by, thank you, Shizad. Absolutely correct. £10 per unit times by 75,000. I'm reminding you the chapter going to be more exciting and challenging later on. This is just an easy thing we're doing. Yeah. So full focus needed throughout the lecture. Yeah, this is recorded. You can watch it out later on. So 750,000 is right answer. What is another way of getting it? Divided by CS, Ray, she. Oh, okay. Activity 1 you got to do. Maybe some of the activities I might have to skip in this chapter because of long chapter. But activity 1 I want you to do. I will give you. Let me see. I think 10 minutes is enough to finish everything here. Yeah. So everybody, you can take a picture of this. I'm giving you enough time to take a picture. 1, 2, 3. Picture taken, I believe so, of this activity 1. And here is the answer you need to do. So Mr. TikTok is going to be on a screen. I'm going to be quiet. Use your book. Everybody use your book, please. Thank you, Shizad. You're going to use your book. Please do use your book. Yeah. Pen and paper, write it down. Okay. Your 10 minutes started now. Do it. Send me the answers with full breakdown. Thank you. Okay, already getting some answers. That's great. Thank you, Umit. I'll be waiting for more people's answer. I gave you 10 minutes. Does take a little time to do it. Faiza, thank you for your first answer, which looks like the Umit's answer. Yeah, I'll be definitely waiting for the last minute. Yeah, so keep doing it. Thank you. Oh, good to see other students, Samuel, Shizad. No, good. Keep going, yeah. Thank you, Anthony. Shizad for the last one. Please check. Keep doing it, everybody. Okay, I think quite a few students already participated. Just those of you didn't, still you have few time. So, uh, yeah, this is your variable cost, more variable distribution. Total variable cost is given, sales less variable cost, you should get your contribution, which all of you got already. Even from Anthony's latest CS ratio, you can see it. Then factory admin, total fixed cost 150,000 is given. Thank you, Pfizer. Yeah, 150,000 looks like fixed cost plus target profit. The one latest work from Pfizer, I can see it. Yeah, budget sales are given. Revealing the answer. That's the answer. Well done. Contribution is there. This is your fixed cost divided by contribution per break-even point in terms of revenue. And all of you got very well done. Maybe slightly one of your answers for E, I saw. No, that's good. Yeah. Ooh, Samuel, you just need to put the formulas. Yeah, nothing else. Yeah, I think you participated. Did you not? Not yet. No. Oh, you did. Yeah. Which one exactly you want to go ahead? Oh, I'm stuck. You said okay. First question is about break-even point. FC, fixed cost divided by contribution. Our fixed cost was 100 plus 50, 150, wasn't it? Yeah. And contribution is, what is the break-even in revenue? Break-even in revenue is this. Yeah. Once you get the break-even in terms of unit, which is 3750, multiply by selling price, which is 100. That is the one. Yeah. I hope it helps you now. That is the way you got break-even point in terms of revenue. Once you get in terms of units, multiply with the selling price. Or you can divide it with CS ratio, because CS ratio meant to do maybe for later. You are welcome. Moving on. I don't want to spend more time